Howdy, howdy, folks. How's everyone doing? What's going on, Jones? Hope everybody had a wonderful Christmas, wonderful holidays. Howdy, howdy, howdy. I've got another phenomenal guest. What's up, Alexander? Alex, what's up, Beast? Yo, yo. I'm good. Casey, what's up? Edwin, howdy, howdy. What's up, Nick? I see you in here. I've got a phenomenal guest this evening. What's up? Happy New Year to you as well, Alex. Appreciate that very much. Well, almost Happy New Year. Stone, what's up? What's my New Year's resolution? To make sure that I am the best individual that I can be with everybody that I work for. Everybody that I work with, excuse me, I don't work for anybody anymore. Everybody that I work with, excuse me. And everybody that decides to work with me. There he is. I did have a great Christmas. I hope you did as well. Great late 80s stash. Thank you. I got a little stash going. Oh, speaking of the stash master.
What's up, man?
Good sir, good sir. How are you?
I'm hanging in there, man. I came down with a little bit of a cold, but I can't miss this, man. So we're going to tear it up and have a good one.
Hopefully this will make you feel a little bit better, huh?
Oh, yeah. I'm always excited to talk markets with you guys for sure.
I appreciate that very much. Well, guys, first of all, I cannot express how much I appreciate this gentleman right here. We've had so many lives, so many conversations. I've learned a lot from him, which is why I can't wait every single time to get him in front of you all, because I know how much you guys will hopefully retain and learn from this gentleman. I just need to ask the right questions, right? So, John,
Sure.
if you don't mind providing a little bit about your background. I know you've done it a few times already, but for the new folks, we got to hear what.
Yeah. Yeah, absolutely. So I'm born and raised California at 18. Got the boot from my parents and joined the military. And then after that, used the GI Bill to go to Texas A&M. Got my undergrad and master's in economics. Then I started working for the big banks. I was a mortgage-backed securities trader for 3.5, 4 years. Picked up the CFA charter. And then about a year ago, I decided to do my own thing, and now I'm head of investment strategy at a small investment advisory firm now.
That's incredible. You've been around the block. You sure as heck have a lot of experience, and I know that to be true. So that's
Yeah, a little bit.
Yeah, you got a little bit more than a little bit, right? You got skirts, you got everything that I ever wanted to have when I was in corporate finance. So you're a little bit of a role model to me, absolutely. So
I appreciate it, man.
No, absolutely, well deserved. So we've got. I never can count on how many topics I have on any of my hands that I have, even if I had an extra 6. But one of the things that I really wanted to talk to you about tonight, a lot of these lives, we talk about options, we talk about short-term work, we talk about leverage trading, a bunch of different things. Tonight, I wanted to talk to you about something that I feel is more important for everybody that cares about their next 10 to 20 years. And I'm talking about the growth side of portfolio management. I'm not talking about, dipping into mutual funds for 20 years and hoping it goes well, right? I'm talking about active portfolio management. So in regards to that and that major, major topic, how are you handling the choppiness of the market right now, the volatility and everything else that's going on?
Yeah, I mean, I think first when it comes to if you're going to do active management, which if you're going to do active management, you should have some experience in the market. You can, you can phase into it. So I wouldn't go full on 100% stock picking for a lot of people. But the way I look at it is, hey, first, build a portfolio, a strategic allocation that fits my long-term goals, my liquidity needs, all that. And then when it comes to wanting to have more active management, then within those strategic allocation ranges, then give yourself room, tactical allocation to add additional risk-adjusted return, alpha, so to speak, in your portfolio. Right now, with all the volatility, I have to understand and recognize that there's going to be some bumps down the road, but I'm in the business of holding quality companies for the long run. And I do realize there are going to be some years where I underperform the market. This year wasn't one of those, fortunately. But that's just something you have to recognize, that is the business of doing this, that you can't outperform every year.
Right.
So
we can only hope to do as well as we possibly can every single year. And what you and I try to do as best as we can is we're trying to manage as much risk as possible. Also looking at growth long term. We're trying to look year over year, see what kind of issues are going on with the economy, how we can kind of play and protect ourselves for said issues, right? So in regards for volatility with your management on more of the active side, and I appreciate you saying, it takes a little bit more time to get more into the active of portfolio management. And guys, we're talking about with portfolio management, we're not necessarily talking about a 5 or 10 grand, account that you're trading with. We're talking about, okay, you've got a job, you've got a 401k, you've got a higher source of income, and you've started to build maybe a 6-figure portfolio, right? Or something with a little bit more leverage where you can allocate properly and see, 10 to 15% being a nice number and a good yield for you. Which a lot of people want 10% of trade, right? Sometimes not as realistic, but we try to, make sure that you and I are here every single year, right? We don't want to go anywhere. So what are you doing with volatility right now, maybe as well as downside protection, if anything?
Yeah, I think the first thing that I have to understand is 2021 was a weird year in the market. And there's a stat, 85% of actively managed funds are going to underperform the SPY. And what happened there? Well, there was this kind of flock end of 2020, early 21 into the small caps, and even the value. But as COVID decided to become more of a freaking issue, especially with like your Delta variant and an inflationary supply chain issues, people pumped the brakes and decided to go towards that large component, the size component. And so really, if you underperformed the market, it was mainly because you were underweight the large caps. And going into 2022, I think the first thing you have to understand is return projections for 2022, I think, are going to be lower. I think that's just the reality. GDP, I think U.S. forecasted 3.8%, lower than global. So with that in mind, I think you have to understand that there's going to be more sophisticated rotations going on. With that, I'm still long-term bull in growth, still long-term bull in tech. I think that's where you have to be long-term. But as far as directing future capital, because I think when it comes to managing a portfolio, the best thing you can do is consistently invest and consistently flow capital into your portfolio. And I'm more interested in flowing capital into more of your defensive sectors for 2022. I think valuations got really heavy. Again, long term, I think your large cap tech is going to do really well. But if you want to add that alpha or that additional risk adjusted return, when I look through like the EV to EBITDA valuations, healthcare is on the list of one of the most attractive sectors in 2022, in my opinion. You got names like Johnson & Johnson. I like Johnson & Johnson going into 2022. They're going to do they're going to split their stock into two companies rather. So that's one to pay attention to. But I think the biggest thing, and you and I talked offline, if you have a portfolio big enough, utilizing covered calls, cash secured puts, option selling strategies. That's how you manage your risk in your portfolio, generating that additional fixed premium in a wake of volatility that I don't think is going to go away in 2022.
Well, there's a lot to cover there, and I agree absolutely. And options are an incredible way to help with that volatility, as well as and a lot of people don't know this, but there's a lot of ways, just like what you mentioned, that you can utilize options at no risk to you, right?
Right.
Cash secured covered puts assign you at a certain price that you get to decide exactly what you want to buy the 100 shares for. Same thing for covered calls, right? You get assigned and you sell your 100 shares at a price that you choose. And
it's a win-win. It really is. The only thing you got to be careful of is, and I get worried about this, elevated volatility. I think people's eyes when they get into option selling, they chase the highest premiums. Earning these premiums is great, but if you're sacrificing long-term capital gains, you don't want to be doing that. So I say when it comes to selling these covered call legs, make sure you're not doing it on highly volatile stocks. I know you have a different approach. I know you utilize on the leveraged funds, but for me, I'm doing it more on your value oriented, income oriented stocks, usually trading in the 30 to 50% IV. I know you're probably, well, what are some of the options you're selling at IV wise? What do they look like?
So I actually, that's not one of the things that I look at in regards to implied volatility. So I look at the underlying. So then, for example, the setups that I'm using, I use covered calls, not at a point of exercising or selling my underlying position. I utilize covered calls on I'll throw some names out, and then I'll explain what I do with them and why I do what I do. Because this is something that has helped my portfolios probably more than anything right now, just because of how choppy we've been. So I create very strict parameters, and I don't go premium hunting necessarily, which can a lot of people that are trying to get a lot of premium, and they might get real close out of the money. And then, oh my goodness, NVIDIA went up $20 a share. I'm blowing out my covered call because I was trying to get $1,000 in premium.
Right.
And then losing the difference. So that being said, it's still a win-win. You're still making premium. You're still selling your shares at a good price. But so for what I do is I own a lot of the tech sector, right? I've got covered calls going through Apple, NVIDIA, AMD, and great names, great companies long-term. And then another, I've got covered calls going through SPY, QQQ. I'm utilizing covered calls on SSO, SPXL, and I'm taking. So if I were to be able to afford 200 shares of SPY, I'm fine holding the 200 shares of SPY because I don't want to sell covered puts of that large of a position. But if I want to own 400 shares of SPXL, I'll leave 200 shares in cash at all times. The other 200 I'll buy on a major pullback. I'll wait till we get to all-time high. I'm covering them at all-time highs, $20, $30 out of the money, 6 months out.
Okay.
So the next time we come, so we're at all-time highs, and it's usually an extension of all-time highs. Soon as the market falls, those covered calls generate about 40 to 50% of premium because the IV is so high on those triple leverages. So if I'm netting $2,000 6 months out of the money on that premium, and the very next month, SPY sees a 5% fall, which is for SPXL, it's a 15% fall, not to mention QQQ and TQQ. Market falls, I'm netting 40 to 50% on those covered calls, and I'm clearing them. Soon as I clear the covered calls in a percent-based allocation of how far the S&P falls, because I have increments, I leg in and I leg out. As soon as I'm legging out on the last couple hundred increments, I'm selling covered puts $20 to $30 a share below where I'm closing the covered calls. And those premiums, I'm getting them out 6 months. 90-something% of the time, I don't get exercised and I never get filled for those covered puts. But I always keep the cash on hand in case, for whatever reason, I want to get exercised or the market stays that low for that extended period of time, which could very well happen, which is why I only sell covered puts on strikes that I want to purchase the shares for. And I have properly allocated and mapped out. And then I do not sell any covered puts on securities at all.
Okay.
No covered puts on securities, only on the leveraged ETFs and major ETFs. That makes sense. I do. I am so worried that because NVIDIA, like I said, we went from my average cost back in September was $185 a share for NVIDIA. And I was removing 2/3 of my position in the low 300s. For management purposes, that's a ton. But guess what happened? We went from 349, dropped all the way back down to 270.
270.
So if I'm doing shorter term covered puts, I would have gotten exercise somewhere in there, and I would have not been pretty happy. I would not have been happy. So that would have been, $27,000 going out at a price that I might not have wanted, right? So for the ETFs, I'm fine getting exercised at the strikes that I pick. Individual securities, I just use covered calls when they retrace, and I am determining when I want to. So, for example, I sold a couple increments of 100 shares of NVIDIA, and then re-injected it at a major support line, and it was a large percent down right in the 270s. But I
in NVIDIA, right?
Say again.
NVIDIA, right?
Yeah, and I re-injected half of what I took profits on, left the rest in cash. And I took that, and I'm selling that. I'm selling puts against that cash for SPXL, SSO, TQQ.
Makes sense.
And netting a lot of premium. And based on current numbers, unless SPY fell in excess of 15%, which could happen, I won't exercise in the next 6 months.
But if the S&P 500 falls 15%, I want to be buying it as I want it to get exercised.
Correct.
Right. And so that's I think someone asked a good question.
Okay.
About diversification. Like why, where did they, I don't know. I think we missed.
It was Henry. He's one of our live chat OGs. He said, can you go into depth how diversification is not in your favor at the moment? Well, do you want to take that first? Because I've got quite a strong opinion on diversification at the moment.
I would take the opposite stance and say it is very important to have diversification in your standpoint. I think you have to be, if you're a young guy with a long time horizon like you and me, I imagine you're pretty tech growth heavy. But if you want to limit downside risk, if you're trying to achieve alpha, I think in a world where we're getting 3 rate hikes, and it's not just the hikes itself, it's the speed.
Yep.
I think there is going to be, I don't think we're going to see the same market that we saw these last 2 years. So I think diversification is a huge, huge help from that standpoint. I always recommend a diversification standpoint, because for the common investor who doubles down or even triples down on a position that's down 30-40%, especially on some of these hyper growth shitty companies that we're seeing that are down 30-40-50%, these hyper growths that are trading at like 100 or 200x price to sales. Adding to your conviction stocks doesn't mean you're going to do well in 2022. I think people have to understand, just because you have conviction on a stock doesn't mean you're going to do well. And so I think you got to hedge against the ignorance and the understanding that I think the markets are going to be choppier in 2022.
I think that's incredible. That's exactly what I've been sitting around and doing. I build my own little round table and I consult everything that's on it. I try to look at what's going to happen in the future in regards specifically to the rate hikes. That's going to increase. And I've gotten this question multiple times. Do I think the interest rates are going to increase volatility? Why not? Right? I have no doubt in my mind that volatility at the bare minimum will be increased. Now, is it going to be volatility to the downside? Are we going to see some red? Most likely. And if that happens, you guys, there's a lot of people that are asking these questions that aren't looking at a 10-year horizon for their management, right? If we have a really bad year, or we have multiple, let's say we haven't had a 10% correction in the S&P in a while. So if we got 1 or 2 of those in 2022 and it holds relatively the same growth, maybe 7 to 10% this year with the hikes, you're still buying at a 10% fall, and you're looking 6 months out, you're still 10% up once we recover, right? And anything averaging into that, and that's what I try to talk about in the live calls, but a lot of people are waiting for confirmation for it to go back up. I don't want confirmation, don't care for it. I'm legging in percent allocation based on all the calculations that I have. I pulled them up in front of me. I know exactly how much I'm legging in, all the way down to SPY almost not even existing. And
and that's a good point. Chasing returns, people like wait for green prices, like positive price action to reaffirm them getting in. And that's why people end up buying high and selling low, because they chase. And I think you have to look ahead. The best way to manage your emotional biases that you and I both have, and everyone watching has, is a diversified portfolio. And what is that? That means different things to different people. That doesn't mean hold bonds per se. I'm not saying that at all. What I am saying is, don't just heavily invest in 100% of your money in electric vehicle companies. Like, you're not going to have a good time. You want to be diversified across sectors. Someone asked about 50% in dividend stocks. Personally, I stay away from making too drastic of changes to my long-term strategic outlook. For me, I might have 10 to 15% of my portfolio in more value, income-oriented positions. I likely am going to up that to like an extra 5% in 2022, but 50% of your portfolio in income-oriented stocks, I don't know about that. That's a huge element of market timing, and I don't believe in timing the market to that extent, that heavy.
No, you're hitting every nail on the head that I've got, as always, which is why I love talking.
Yeah.
But for me, since I'm micromanaging everything, and a lot of the hedge funds, you and I were talking about how Wall Street's performing right now, which a lot of these major funds are very much underperforming the S&P 500, which the major issue that I see with that is there are a lot of these hedge funds that are, they have 500, 600, or 700 different companies that they have different allocations into. And for me, the majority of my positions are in a few different, and I can go over them. I've got SPY, QQQ, VO, VGT, SPXL, TQQ, SSO. You were talking about the double leverage for QQQ. I'm looking at IHI. You brought up the pharmaceuticals. IHI, phenomenal ETF, been performing.
That's medical devices, right?
Yep, I believe.
Yep.
I don't know what the technical title is off the top of my head.
Yeah, I think it's medical. iShares medical. Again, I think that's a really strong one to pay attention to.
Yep.
I do like, because some of the healthcare, you are going to see some dividend payers, and I also like hospital REITs, medical REITs.
Okay.
So something like MPW, really strong 5% dividend. Their free cash flow from operations is increasing. MPW is something to add to your watch list for 2022. That's something to look at.
That's excellent. I'm looking. So yeah, it was the medical devices. It's been doing very well. One of the things that I try to do is every now and then I will poke at the select spider. I'll look at BlackRock's funds and see how they're doing. And if you look at them, there's a couple of selects, sectors, ETFs that are doing very well. And then you've got other funds that on the year that are, bonds and et cetera, that are down excess of 2% on the year. So it's neutralizing some of this massive growth that BlackRock's able to create in the 26 year-to-date return percent, 22%. And then they're so over diversified in different things that it's bringing them back down to an average of 12%, for example.
Right.
So,
and that's the thing, it's if you stray too far away from big tech companies, you are going to underperform. That's just the reality. That's what the data suggests. It's hard to bet against the Googles, your Facebooks, your Apples. I wouldn't recommend not investing in those. You should have exposure to those because I do think they're going to hold up quite well. And you're talking about QQQ or SPY, extremely top heavy. Those, the top 10 holdings in those indexes, 30, 40, 50%. So when in doubt, I think these major indices like the QQQ and the SPY, if you don't want to do stock picking, I think those are going to do really well long term. And I still think, SPY, I don't think it's going to print a 28, 29% in 2022. My expectation is 5 to 8%, somewhere in that range. Again, that's not horrible. It's just something. Don't go expecting double-digit returns and try and chase these stocks that you think have that potential because you're going to get burned. I just think across the board, equity projections are going to be lower, and you just got to tread carefully. Don't try and chase too much.
So you mentioned these ETFs being very top-heavy, and as of late, the driving factors for QQQ and the S&P have been a few names literally on both hands, right? Tesla, Apple, Microsoft, both classes of Google. Facebook's been underperforming a little bit, but after its growth that it had prior to underperforming, unbelievable. You've got Netflix, other big tech companies, AMD, NVIDIA, semiconductors, LRCX, another one of my favorites. So what I'm looking at is what's underperforming in these major ETFs, and what would happen if we had a sector rotation. For example, you and I talked about this was about a month or so ago, and you and I were talking about how hard fintech and the credit services are getting hit, right? And small and mid caps, IWM, BlackRock small mid cap, VO, Vanguards, underperforming, right? And they're underperforming, and their holdings are underperforming. So if we had what I'm trying to figure out for 2022, and maybe that you could shed some light on this, if we had some sector rotation and the big techs slowed down a little bit, which chances are they will with the rate hikes, and their rate of growth could be the same. But if we fall, or if we have 3 or 4 20% pullbacks in tech, which is not unheard of by any means whatsoever, had a 12 or 15% pullback in September in tech, and that was because everything was overextended, and then we just rocketed right past it. So now we're overextended again. So if we had a sector rotation into fintech, credit services, into energy, for example, or people started buying small cap, mid cap, what do you think it would take to get that rotation so that S&P, QQQ become a little bit more spread out, right? Not as heavily weighted with the top.
Yeah, I was looking at this from a value standpoint. People's eyes are going to gravitate to small cap because they're trading at, on Morningstar, just pulled it up. They're trading at 91% of fair value. Large cap growth is trading at a multiple of 1.2 to fair value. So obviously large cap is overvalued per Morningstar. But what you're talking about is the sector rotation in the small and mid cap. I don't see it going that way. I still think it's going to be more defensive, more fairly valued, and I don't see small and mid cap fintech. I still think they're lofty valuations. However, what would take for that to happen, I think, and this is what people are thinking, we're going to get 3 rate hikes. That's what they say. But given where the 10-year is, it's still trading below 1.5%. And they're worried that the curve is looking like it's getting flatter and flatter and risk of being inverted. What if inflation falls faster than people think? The Fed's projections 2.5% inflation by the end of 2022. If that happens, maybe they pump the brakes on the rate hikes, and that would be fuel, I think, to what you're talking about, more to that small and mid cap. But right now, though, I'm really hesitant overweighting small and mid cap companies. Especially the companies that are pre-earnings. When you're talking about rate hikes, these are long duration assets, and you're talking about discounting these cash flows at higher and higher rates. It affects the valuations. I think you got to tread carefully at going all in on small and mid cap because I still think there's room to bleed there.
No, yeah, that makes complete sense to me. That aligns where I'm thinking here, and the reason why I'm asking is because I am trying to figure out what it's going to take to make SPY more evenly weighted. So I personally, excuse me, I
don't know. That's a great question. No one knows.
I try to ask the best questions, the questions that hopefully won't waste your time, right? So I'm trying to figure out what's going to make it more evenly weighted. And I personally, you're not going to catch me or see me ever allocating any cash into any smaller mid caps. I just don't have money into it. But what I do have money into is the S&P and QQQ, and I leverage that quite heavily. And I also protect my downside. So I am not unquestionably, I'm a positive human being, so I'm very bullish on everything SPY and QQQ. But that being said, I'm realistic, and I have to cover myself. On the flip side, the reason why I asked about the sector rotations is because if you go and you look at the top 50 holdings of SPY, you've got the top 10 block outperforming and the bottom 40.
Right. It's getting shit on hard.
Thin ice. So.
Right. So, and I think another thing that you could pay attention to for people that are opportunistically, I think the biggest thing, I do think we're going to see a correction in the market. I think that's a reality. I talked about how the market's going to close green. I think it is for end of 2022, but that isn't before we get a market correction of 10 to 15%. I think we're due for one. I think from a probability standpoint, you have to bake that into your expectations. I think there's an opportunity there where, hey, how can I get more cash into the market? So I think start building up your cash allocations. Again, I deployed a lot of it in December. I bought pre-Fed meeting, I bought 2x leverage QLD. And that's done really well. I'm up 8% on that trade as of 2 or 3 weeks ago. I made to the tune of, because I manage larger portfolios, 7-figure portfolios, good wins there. Those are 80 to 100 grand wins. But it's something to pay attention to that, those leveraged funds can be a great opportunity. I think you have to understand the risks there. There are some risks as far as the decay of daily reset of leverage, things you got to pay attention to. But I think those present an opportunity when markets pull back, I am going to look at getting more liquidity in my portfolio and using that cash allocation towards those leverage funds.
That's
Keep them small though. I'm not talking about putting 100% of my portfolio on a triple leverage QQQ. That's not what I'm talking about. I'm talking about like really precision type, maybe a 5-10% allocation, really scalpel approach, because again, risk adjusted return matters. I'm not trying to bet my entire 7-figure portfolio on a triple leverage ETF. It's not happening.
Right. And and there's, yeah. So you're asking about direction on leverage funds. What Josh and I are talking about right now, and what I feel the most safest with is the oh my goodness, I'm forgetting the primary name for them. This is the pro shares. I'm mostly referring to, and also QLD is not getting a 2-for-1 split. The two that I'm focused on are SSO, double leverage for SPY, and then the triple leverage for QQQ, which is TQQQ. You've got UPRO, which is the Pro Ultra shares of the S&P. I believe that's the triple leverage, and then you've got a couple others that are splitting as well. But the reason why I'm far more comfortable is because I'm taking the exact same approach as Josh is for this. Guys, you guys are asking about other triple leverages. I am not touching semiconductor triple leverage. You couldn't pay me to. I'm not going to do it. It's a risk that I don't want to deal with. Is there gains to be had? Moderately.
I get worried about semiconductor. That's a scary spot to be when supply chains, and demand starts to settle down. These valuations got quite lofty on NVIDIA, which is why you and I took profit. I mean, I think we recognized we were up 60, 70% on both. I mean, you and I were up 60, 70% on NVIDIA. I paid myself first.
Yep.
I'll say that.
Yep, absolutely. I left a third of my position in there and then just sold covered calls 6 months out into the. I've got, oh my goodness, I think I'm in the 400 strike range. So if those shares are exercised in 6 months, my average cost on those shares are $185. So if they get exercised, don't care. Couldn't care less whatsoever. And I'm running this bracket covered call strategy on my major equity positions, and I'm using the covered calls as bearish protection. So I'm not really ever getting exercised on these, which the good part about that is I get to keep the majority of my equity positions, so they're not short-term capital gains anymore. That's the big thing for me. So I'm building these positions up year over year, and I'm keeping enough cash year over year to make sure if we do get, and I'm sure we will, get a 10 to 15% correction, which for double leverage, 10% is going to 20. For triple, 10% is going to 30, folks. We're buying in or legging in there. And that just means if I'm getting 100, 200 shares down at that 30% level, we retrace back up to the high, I'm getting about 30 to 35% upon extension of all-time highs once we recover. And I'm getting equity. I got no time for this. I'm just legging in. I'm putting cash into the portfolios. I'm legging in accordingly. And I'm making sure that cash is going to work. And then on the flip side, in order to not take any risk in legging into potential options positions, I'm selling covered puts at these lows, at those pullbacks. And I've got everything planned out to fake scenarios and then real scenarios like '08, for example. I've got it all mapped out. And then COVID, got that mapped out too. So that was just me going out on higher time frames and looking at it from okay, am I going to last through a COVID? Am I going to last through an '08? How am I going to manage this? Are my options going to expire before the market recovers? Right? So that's what I'm leveraging. I'm utilizing these triple and double leverages because I would rather do that with equity now than get potentially leaps, for example, that the volatility could destroy them, potentially losing 80% of the premium I'm putting down, right? So if we had a market, a 20 or 30% pullback.
Someone asked, why not semiconductors? I mean, I like semiconductors. They're a part of my long-term strategy.
Same here.
But don't get me wrong. I'm not really anxious to be adding too much right now. I mean, they've been on a tear, and that's been exacerbated by supply chain constraints. And I just think when I'm trying to opportunistically add capital and build a diversified portfolio, I'm more interested in legging into more of these healthcare financials, things of that nature, because I want to get growth at a reasonable price. And I just do feel like semiconductors, a lot of them got pretty lofty in 2021.
Yeah, I've been holding my NVIDIA position. I've been trading in and out of my shares purely because of what you and I were talking about. These 70% swings, which are astronomical. I've been holding large chunks of NVIDIA and AMD. I've been holding AMD for years, since $40 a share. And I've been trading NVIDIA since pre-split, and we ran from what, 400 or 500 all the way up to 800, split back down. Now we're in the 300s again. It's almost absurd. It's almost absurd, which is why I'm happy I'm in equity, because I can manage it accordingly. And the premium's so high, I'll run cover calls against it. And if it gets exercised, great. If it doesn't, great. Doesn't matter.
Great.
Right? I'm going to hold the position regardless. But just like you, there are things that I take a look at different sectors and et cetera. I'm a tech guy, so I love tech. But that being said, I'm also as realistic as you are. Tech and AMD and all these things, 100 multiples up from where they were not a year and a half ago, right? It's astronomical. So I'm just looking for sustainability here, and I'm looking to make sure that I'm getting more concentrated. But my concentration's in major ETFs, so I'm concentrated in diversification, I guess.
Which, when in doubt, I think, and you and I were talking about this, when in doubt, those major indices, you need to have exposure to them. I mean, I have exposure to them. You do. Most of the experienced guys in the market, I know, they have them. All the experienced guys, because they recognize if you want a chance at outperforming, you can't stray too far away from those indices. You got to take a scalpel approach, but you can't jump too far away from those indices because you'll get in trouble.
No, I agree. I think that's fantastic, and I appreciate the indirect compliment. That was very kind.
Right.
So right now, really, what I'm looking to do is, if the S&P is producing in excess of 20% this year, and I think we had 3 or 4 this year, 5% definitive 5% pullbacks. And if I'm, this is not a market where you can do this all the time. So I have to step back and realize, hey, if we have a 30% pullback and we do not return up as quickly, retrace as quickly as we did in COVID, I've got to take a step back and realize, okay, what options are not going to work in this element? Now, that's why I've switched a little bit more over to equity. And I thought to myself, okay, SPY equity costing as much as it's going to cost me is not going to make me what I want to make. Plain and simple.
Right.
Charge to my income, growth, etc. So the way I'm taking on a little bit more risk is by utilizing the double and triple leverages, because they're buying those dips, buying them at major pullbacks. I'm not trading them, an extension of all-time highs. I'm not doing any of that. So I'm covering my butt by keeping 30 to 40% of what I want to allocate to those positions in cash.
Right.
And I'm just making sure I'm covered either way. So I'm not, a lot of people think the triple leverages are extremely risky. But if they're a 5 or 10% part of your portfolio that's utilized for growth, and you're managing the risk appropriately, and your average cost is getting better and better and better, there's nothing to worry about here.
And that's how alpha is achieved. It's through like a scalpel approach. You're not the funds that outperform consistently. It's not because they're betting it all on 1 or 2 stocks. Most of them, a lot of your good funds might have 30 to 45 positions. A lot of the good funds, and so that's just something you have to recognize. It's portfolio concentration over the long run can really hurt your portfolio, especially for new investors. Which I'm assuming, a lot of people that follow you and even me aren't that experienced. Jumping into a purely concentrated portfolio of 2 or 3 names can really hurt and give you some pullbacks that you can't even handle. I had one guy, he had 3 positions, one in SoFi, couple others, and he's down 40, 50%. And, how do you recover from something like that? You got to up your earnings. And what the trap that people get into is, oh God, I'm down 50%. I'm either going to hold the bag or I'm going to do this gambling thing and just take that loss, but then throw it all into another potential opportunity that has a potential to make up the loss so I can break even. And you get into this perpetual cycle where you're not really. Look, the reality is anyone can generate 100% rate of return if they gamble 100% of their portfolio.
Right.
I mean, you go to Vegas and you do that.
Right.
The good investors are earning multiples, double-digit returns with only risking percentages of their portfolio. So that's where risk-adjusted return comes in. I mean, anyone could just gamble and throw it all into one stock.
Yep.
It doesn't take skill.
Right. You're absolutely right, which is why, a lot of, I guess my generation, our generation that's investing in a couple of different stocks and they're doing 200 or 300% return. It's not necessarily skilled investing, right? If you're buying Tesla and you're catching a major wave, right? Because
right.
what you and I are looking to do is making sure that you and I, when we're having a drink at a bar in 30 years, you and I have been netting as close to 20 to 30% a year if possible for the entirety of that time. And then you and I get to get whatever drink we want at said bar, right? So
yeah,
that's what I'm looking for. I realized moving away from being so options heavy that I want my primary concern and priority is that I want to be here in 30 years. And the way that I have to do that is kind of developing my own way of understanding how I can manage and how I can emotionally handle my company, et cetera. But the other big thing is there are people who have been doing very well for a very long time and there's something that they figured out, right? But then there's times where they underperform. So just like I tell people with politics, get all the information you can get and then make your own decision. Don't go hopping into anybody else's boat. Make your own boat with everything you've learned. And that's what's helped me so much. There's not a whole lot of people that like my major holdings are between five or six ETFs. And that's what I cycle in between, and I use options to protect myself. And doing very well. And the ETFs, I'm going back and looking at all these different charts, and I could throw a dartboard at securities, and let's say 50% of them didn't recover well after COVID, 50% of them outperformed after COVID, but the ETFs, every single one of them went right back, retraced back to previous highs, did well. Major ETFs, SPY, QQQ, the Financial Select Spider, the tax, everything, right? They were all retraced right back. And in my opinion, I always say this, whenever we have a market fall, the first thing to recover is SPY. And I always say that, and that's how I handle myself with my allocations. So
one of the big, if we got time, someone asked about Fintech.
Yep.
So Fintech valuations got lofty. They've been hammered, second half of this year. And the way I like to look at it is when people are down big on these stocks, what they end up doing is they like to average down, which means they continue to pump cash into these positions that they're down 20, 30% to kind of lower their cost basis. And in theory, it makes sense. But I'll tell you, from an emotional standpoint, I would hate to be adding significant capital to these fintech companies, especially like your Squares and your
PayPal,
your SoFi.
Yeah.
If you have a healthy weight, I wouldn't add more just for the sake of adding more because it's down, because I think the bleeding is going to continue. And I think people let their risk appetite widen when stocks get into a beating, especially some of these fintech. And I just think the bleeding isn't done yet. You got to wait. Keep your positions as long as they're a healthy, fundamentally strong company and the fundamentals haven't changed. Hold the positions, but I'm not in a hurry to add, if that makes sense. I'm just not.
No, I think that's a great answer, and that's something that a lot of shorter term, narrow visioned individuals don't really look at. For me, I have decent sized positions in Square and PayPal. Am I getting destroyed right now? Absolutely.
Right.
But that said, I allocated properly into them, and based on how far they fell, I've got the proper amount that I want. If I'm down on the positions, maybe I cut some for taxes. Maybe I leave the rest alone.
Maybe.
But the biggest thing that you hit on the head that I love is I'm utilizing cash for what I do not have to wonder, okay, is PayPal going to provide the revenue that I need in the next couple of quarters to retrace the position? I'm not adding capital. I'm thinking to myself, okay, PayPal's down excess of 30%. SPY just fell 5.5%. What would weigh out better for my capital? And let's say
probably SPY. Probably SPY.
Most likely SPY in every single scenario. Even if I were to say, oh my goodness, Tesla's down 30%, still going with SPY. And I can leverage SPY. I can protect myself on the downside. PayPal, I've been running covered calls to net premium back to cover my losses on the downside so that my overall share loss isn't that bad. But like you said, for the positions that are getting hit that you guys are possibly hurting on, which often one of the fine gentlemen at OBR and I talk about all the time in our live calls, we say this a lot. SPY looks great. NVIDIA, a couple other tech sectors, few companies here and there, they look great. But not a lot of people are looking at the broader market. If people went in and said, oh my goodness, PayPal's at 196, I wonder how it's been doing for the year, and they looked at an 180-day chart, they'd be crying themselves to sleep, right? And that's not just PayPal. You've got Square, you've got small caps, mid caps. There's a lot of companies that have gotten destroyed, which is why you and I brought up the top heaviness of SPY and QQQ.
Right. And going into 2022, and this is why, I'm not overly bearish. I think a lot of these big companies have a lot of cash on hand. I think earnings are projected to be really well, at least in the first half of the year. Free cash flow has grown. So there's a lot of positives, right? Share buybacks are at the highest levels they've been since 2018. So, there's still signals that the market over the next 3 to 5 years still has some room. So I wouldn't get too worried about trying to move all the cash or selling out of the market entirely. Understand there's going to be some bumpy roads, but there's still quite a lot of heat left in the market, I think.
Yeah, I know. I agree. And for you guys that are doing portfolio management, there's things that you can do while we see volatility. Covered calls, we've mentioned multiple times. For all of the equity positions that I'm confident in holding for the long term to mitigate the volatility and make sure I'm still netting return on my portfolios and my share positions, I'm just selling covered calls. And if they fall far enough, I might get leaps. Small percent allocation in comparison to my portfolios. Got stop losses on the leaps. I'm not going to let those go to zero if we get destroyed. I'm mitigating my risk as much as I can. And the more I mitigate my risk, but also being concentrated deploying these different options vehicles, I'm still netting the returns that I want. I'm still able to make sure I'm eating and driving the car that I want to drive and operating my businesses accordingly. But that being said, one of the things that also you've helped me learn a lot is just overall patience. Take a step back, look at what's going to happen in the future, which I really, really appreciate. You've helped me look at that from a very, very much third-person view, especially forward predictions. So
let's do a speed round. Let me drop some tickers for people to write down, to pay attention to.
Do it.
You want to do that?
Do it.
All right.
Let's wrap it up.
These are some names that I think you should pay. Oh, someone asked Bitcoin. What do I think? Okay, so the problem with Bitcoin right now is people flock to Bitcoin, or people think Bitcoin is an inflationary hedge. It's not. I don't care what argument people tell you. It's not, in my opinion. It's a risk-on asset. So when rate hikes come, it's a high beta asset. When the market sells off, which it likely will, Bitcoin's going to be hurting. I'm still a long-term crypto bull, but I don't see – there's going to be some swing opportunities and to continue to add, because for me, crypto is one of those things where it has to be big enough to be meaningful, but not too big where you lose sleep at night.
Yeah.
And so with Bitcoin, I see Bitcoin trading mostly sideways up until 2024, the next halving. It might touch 100K, but again, I think it's going to be relatively range bound, especially in 2022. I was adding on this last dip at 46K, and I'm glad I did because now it's back up to like 50, 51. But again, Bitcoin, you have exposure to Bitcoin, right?
No, the exposure that I have, my portfolio breakdown for crypto is I'm 70% Ethereum that I cycle in and out on a higher time frame. I leave quite a bit in cash as well. So I'm I guess, keeping my cash in mind. I'm about 20% cash, about 60% Ethereum in this model, and then a little bit Nano and a little bit in Cardano now that Cardano is fallen. So other than that, my large position, I'm treating additional income that I would otherwise waste or et cetera or spend. I'm utilizing that to buy into dips. 10+% dips for Ethereum. And that's really all I'm doing with crypto, just to have another asset class under my belt.
Yeah, I think there's a world where, and I like Ethereum too, Bitcoin and cryptos are going to be more valuable than gold. And our lifetime. I know. I'm almost certain I'll make that bet. So with that being said, I think it'll behoove you. The party's just getting started. So, with something like Bitcoin and Ethereum, I say, hey, guys, don't trade it too much. You don't want to miss out on the upside, so just being a hodler of crypto has worked out pretty well for me. It helps me sleep at night too. So I always tell people, crypto is one of those things where it's a really hard market to trade. Really, really hard. So, continue to buy and nibble on crypto. I nibble weekly, and that'll pay dividends in 5-10 years.
That's excellent. Give us your speed round, and we'll wrap it up after that.
Okay. Take out your pens and papers, everyone else.
Hold on.
So,
1 second. Let me get my Google Docs ready. Let me get this going.
Yeah,
All right,
let's do
ready.
it.
Run it.
Okay. So the first one, Disney. First one right off the bat. It trading below 160 right now. It's a steal. It's up 5% for the month. You want Disney on there. Then Visa. That's another one. Pay attention to.
Okay.
Johnson & Johnson. KRBN. That's a carbon credit futures ETF. Talk about mitigating downside risk is having uncorrelated assets in your portfolio.
Mm-hmm.
This is exposure to this kind of clean energy revolution that will happen in the next 10 years. Carbon credits. It's a futures vehicle, something to pay attention to, KRBN. I like that one.
Beautiful.
NVIDIA, I still think is one to pay attention to and hold. There's still a world where 2022, it still holds up pretty well. Apple, another one you need to have on there. Ethereum, I still think Ethereum is going to do well. BAC, Bank of America, that needs to be on there. I like financials, and Bank of America has high interest rate income exposure. So in a rate hike scenario, they stand to do pretty well. Let's see. Stay away from Wells Fargo.
Okay.
They have an asset cap right now, so they're extremely sensitive to interest rates. Mm-hmm. I don't really like Wells Fargo. Let's see. Google is another one. I think Google is actually fairly valued at this point, and I think it's going to be doing really well in 2022.
You think
Qualcomm is another one.
Yep.
I'd like that one going into 2022. CRM is another one. They've been getting hit a little bit, but I think they're actually growth at a reasonable price long term. I like CRM, so add that to your watch list. Walmart is another one. Go for Walmart. I love that one. And in QQQ and SPY, you got to have those. And Microsoft. That's another one. I love Microsoft.
Yep. I've never gone wrong dancing with Microsoft. It would make me the happiest little boy in the world to see Google do a 3-for-1 or a 4-for-1 split. I don't know if it'll ever happen, but it would make me the happiest man on earth if that would happen. And same with Amazon. That might actually get Amazon out of this major range it's been trading in for so long. I purchased any Google or any Amazon because I just don't feel like spending that kind of capital, and I don't have, because I like to run covered calls on everything I own. So I'm not.
There's no way you're going to run covered calls on that.
I'm not the high roller table yet. I'll get there, but I'm not
right.
Covered call on Google and Amazon high roller. No shot.
No.
So,
I mean, you need to shell out, a few $100,000 just to get that. So, no one's running covered calls on those. Not the average trader. Maybe an institutional desk. But so I like that. Someone asked Baba. I hold Baba. I still think there's some macro headwinds there. The whole China thing, I'm like, the Fintech, I'm comfortable with the allocation. So I'm not looking to add to the bleeding. I think long-term Baba is a steal. So if you're considering a value play, consider getting into it. But I'm not up in my allocation right now to it.
Josh, we were that comment that we just got from Ben, one of our head honchos. We were talking about you today in the live call. We believe that you would be the greatest professor of finance. You should be at Harvard or Oxford or MIT teaching finance. There's no better place in the world. They'd be lucky to have you, be paying you. They should pay you probably 20% of the tuition they bring in just to have you. I'll tell you that right now. Sit there at the front of the class, you'd be social media famous.
That's what so someone asked charge point.
Yep. Moving on from that.
I'm going to say no. I don't like charge point. I think getting into the auto space, and I have a Patreon where I do a lot of investment research. I covered, and the valuations got lofty. And charge point is one of those. I'm not super excited. Very cyclical. In an interest rate hike scenario, especially with the heavy debt that a lot of these automakers have. I like Ford. Out of all of them, I think Ford's a steal. Long term, you need to look at Ford for EV exposure. I'm looking at buying that in the next 6 months to a year. I think because I don't have any EV exposure,
Okay.
except for the ETFs. But Ford is my big ticket that I think I'm starting to look at.
Any final statements from the professor himself?
Continue to invest in the stock market. I think at the end of the day, don't hoard too much cash because you could leave significant upside on the table. Right. I think you have to look at these market pullbacks as buying opportunities. If you see red, it's just another opportunity to keep nibbling. I think those that continue to nibble over the long run, stand the test of time, are going to do really well over the long run. There's going to be bumps and bruises, but you and I are under 30. So there's no, unless something crazy happens, we're going to do just fine by buying quality companies and continue to buy quality companies over the long run. Quality.
No, I agree, and I appreciate that sentiment very much. And I think that it's fantastic that you're pushing the allocation of cash, making sure there's a huge opportunity cost there. And guys, if you're buying into big companies, major companies that you appreciate the value they provide to not only your everyday life, but you appreciate their future innovation that hopefully they're working towards. Some companies aren't very innovative, but I try to invest in innovation. So that being said, if you guys have large positions because of your conviction in these different companies, make sure you educate yourself on how to protect the positions you own and you're leveraging.
And holding the bag is not proper risk management.
No.
Like if someone bought Rivian right now, if they bought it at the 150s and 160s, it's sitting at 102. Don't hold the bag. Consider taking and realizing the capital losses, learn your lesson, and reinvest the capital elsewhere. Because I don't care who you think you are. Something like Rivian, good luck. Good luck. You're going to be holding for a while.
We're just gonna have to end it on that, because if we start talking about Rivian, then people are gonna start asking me about shit like AMC. I'm not here for it. So
yeah, hell no.
Josh, thank you so much for the hour of this time that we spent together. I learn something from you every single time I sit down and get to chat.
Appreciate it.
I really appreciate that. So let's check in soon. I'd love to have you back on. There's the viewers that sit around and listen to these conversations will, in my opinion, and not to toot either of our horns, but they're going to learn a lot. And what we're trying to do here is cut a major learning curve that Josh and I have dealt with and have run through so many walls dealing with for years now. So that being said, Josh and I have successfully ran through a few walls. I'm sure there's going to be some bigger ones in the future, but we're going to do our best to go through them as quickly as we can. So I appreciate you, Josh, very much. Thank you so much for your time, and feel better, brother.
Thank you. Pleasure.
You take
See you guys.
Yourself.